Well, hello, Maverick traders. Welcome out to your market roundup for October 11th. Corey here with you. Quick reminder, make sure you follow your trading plan and let's get to it. So, as we look at the markets so far this week, a little bit more downside, a little bit more follow through back towards or through those levels of support. The Dow, the S&P, the Nasdaq, all flat to down. You can see a little bit more weakness in the Nasdaq and tech stocks overall. Oil had a bad day today. We'll get to the heat map in a bit. There's a couple of areas of strength and weakness. Advancers versus decliners, a few more decliners than advancers, about 6 out of 10, 60% or so. And then the 50-day moving average, again, the majority of stocks are in a downtrend. That's been the case for months now. Finding bullish setups and bullish trends is much, much harder than finding bearish candidates. And on the daily news, buying strike continues in bonds, treasuries, corporate bonds, international bonds, everything with bond-related fixed income. There is aggressive selling or lack of buying. And then the British pound fell. The Bank of England a week or so ago stepped in to try to stabilize the markets, initiated a bond buying program. They say that's coming to an end. And of course, we have kind of a resumption of that bond route. So it's interesting what's happening in the UK, in that if you think about how these endowment funds and pension funds are utilizing these bonds, well, they think it's money good. If you hold a bond all the way to maturity, then you'll collect the interest, and assuming that whoever issued the bond doesn't default, which in this case is the English government, so you're expecting that they'll pay it off and believing in their parliament, well, then it's not going to default and you'll get your money back. And so because people think, well, that's a zero risk scenario, they're not going to default. They could print more pound sterling if they needed to pay these off. So they think it's money good. Well, the problem is they've leveraged up because of that. They think, well, it's good. We can just hold to maturity. So let's buy more of them and let's leverage our capital. And so with this huge downturn, understand that bonds in the UK have lost over half of their value. They were not expecting that type of volatility, and because they're leveraged, their mark to market right now is showing massive losses. So they are showing, well, basically so big a losses that the brokerages are saying, hey, you can't keep holding all these positions. You need to liquidate or add more money. And this is people's pensions, So they're saying, well, we can't add more money. There's not more money. So we have to sell. And then that further fuels more downside. And then they're forced to sell more, and it fuels. And so it's like dominoes toppling over. If they were able to hold these bonds to maturity, they'd actually make the money, assuming there's not a default in the British government paying off this debt. Well, they're probably not going to default, but they don't have enough time and they've leveraged too much. And this is a big issue. And so this is the thing about leverage. What more volatility, more leverage cuts both ways. They were trying to get better returns. As it stands, they're going to have huge losses in their pension funds. A lot of people are taking a huge hit, which means they'll pull money out, which further fuels more selling. I mean, it's just a tangled mess. And a lot of people are hoping that the Fed is going to do something of an about face, 180-degree, stop their interest rate hikes and so on. Well, this isn't as much an issue in the U.S. This is a UK story. As we look at the S&P, we had highlighted an inverse cup and handle, which basically played out. I thought that we would get a push up to 385 or so on the SPY, 3850 on the SPX. It didn't have that. It had a huge 2-day rally, certainly, even 3-day rally, where it went to a higher level there on Wednesday of last week. But that was it, and now we're back down to these levels. And as we said before, look, maybe it was wishful thinking that you'd get a bounce, but the most important aspect was that this bounce was a shorting opportunity. I didn't capitalize on that personally as well as I would have liked to. I did take off some bulls. I did adjust a little bit, but I thought personally that we were going to get a little choppiness here for a couple of days and then one more little surge here which is where I would have really aggressively shifted. And we didn't get it. It sold off quicker than I personally expected. So speaking to my own accounts, look, I took a hit because I had more bulls than bears, even though the initial rally allowed me to lock in some gains and do some good things. This wasn't a rally that you wouldn't pay attention to. It was like 6% or whatever, straight up for 2 or 3 days. You're going to take some profits off if they have hit targets or whatever that may be, but certainly I stayed more bullish, thinking there was going to be one more little push higher to kind of reach some of those price targets, and it didn't materialize. The Nasdaq looks even worse. Yeah, we got the bounce, kind of that handle of this cup and handle, but nevertheless, we have broken down. We're below support. We're pushing through that level, so as kind of an area, a zone of support, we're essentially breaking that. So the only way you're going to really recover and have this be a fake out is if something changes, I think, in the fundamentals. Right now, the path of least resistance is to the downside, and I see no reason that it's not going to just continue to kind of be pressured lower. As we look at the heat map, it's really kind of a mixed picture. You definitely had weakness in technology and financials. You had strength in healthcare, almost all in green. Consumer defensive stocks, all in green, and most of real estate, all in green. So there was definitely a change here. Now, those are all a little bit more defensive in nature versus, financials and technology, and those would be a little bit more cyclical. Those would be a little bit more dependent upon the economy and so forth. So a couple of areas there that were bright spots. Our weekly and monthly outlook, hard to be anything but bearish at this point. So, you got the nice rally. Hopefully you capitalized on it a little bit better than me and adjusted a little bit more quickly to a negative outlook. Bullish and bearish list, not surprising. I've probably highlighted the energy sector more than any other sector, and it's just the only thing that's still holding up on the bullish side. So look at ConocoPhillips. The market's in turmoil, the market's crashing to the downside, and Conoco has worked its way all the way back up, and kind of a cup and handle type of dynamic, if you want to call it an ascending triangle, higher lows and so forth. Any way you slice it, this is pretty darn good, impressive price action given how bad the market's been. So if we did some back of the envelope math, we'd say, okay, resistance up here is around 120. The cup down here is bottomed out at about, I'm going to call it about 77. So the difference between those, and that's a huge cup, right? That tells you how volatile the energy sector is, but that's 43 points. Usually the handle will be about 30% of that. So what's 30% of 43? It's 1290, so call it 13 points. So this handle should come down to about 107. So we're really not even close to where the handle should be. I expect energy's not trading particularly well the last 2 days. I could see Conoco coming down to around 107. I think you want to scoop it up around there. That's kind of the level where if you are looking at this like it's more of an ascending triangle, that's more of where the trend line would come in as well out here in time, would probably be somewhere around there that those would converge. But anyway you slice it, I think there's a little bit more downside, but I would look to be a buyer. This one's kind of interesting. This is ILF, which is a Latin America fund. So when you're talking about Latin America, now you're excluding, Japan and Europe. You're excluding Russia and China. You're just talking Latin America. And lo and behold, hanging in there really well up here near its multi-month highs. Kind of, again, an ascending triangle of sorts. I think this one is going to go up and through that 26 level, and I would be very interested in this as kind of an ETF play. I think you can kind of expect that there's going to be gaps oftentimes because, again, most of these stocks are trading in international markets. And then this chart just represents how it traded during the US session. So there will be a lot of gaps in there. Just be aware of that. But I think it should continue to work its way higher. And then LNG. I've highlighted natural gas, which is probably the best pocket, the best industry within energy. LNG looks really good. This is a liquefied natural gas company. They'll ship natural gas, which can be helpful, and a little mini cup and handle of sorts here. Again, I think it goes up and out from here overall. So might be a little bit choppy if the energy sector continues to struggle a bit. Now, Citigroup is kind of an interesting chart. First, just obviously bearish on all accounts. Second, it reports earnings this Friday. And I normally don't play a lot of earnings plays. Every earnings season, I might trade a couple of names through earnings. I am looking at Citi as a potential area because they're more of an international bank. And the international markets is where there's been the most pain. Now, I think it's already pricing in a lot of weakness, right, with this huge downturn. But maybe playing it to be neutral to lower some sort of downside to neutral butterfly or something like that. There's going to be a lot of volatility, and I suspect the numbers won't be stellar, so you might get a negative reaction there. We continue to highlight these meme stocks. I think they'll continue to work their way lower. This is GameStop, GME, a descending triangle, low base pattern. Should continue to accelerate lower if and when it breaks this line of support. And an obvious target would be back here around these prior lows at about $20 per share. And then last but not least, we have Palo Alto Networks. We looked at this and CrowdStrike last week and kind of focused on that group. And both of them have gone down sharply. Here's Palo Alto kind of failing at those moving averages and breaking lower. I think we're going to continue to see further decline. So this might be one where you'll get a little low base or a small bounce, and then you look to short it again if you're not already in it. But I would continue to look at those. CrowdStrike, which is CRWD, I believe, and Palo Alto, they both look pretty bearish to me and should continue to work their way lower. So as we've been saying, I've emphasized this for the last few months. We're in a bear market. We've had an inverse cup and handle, and now we're breaking down out of that. I got caught a little bit too bullish, thinking there was going to be a little bit more upside, and I've had to scramble up here over the past couple of days when that didn't hold. Was it Thursday of last week that was really kind of the deal breaker, where instead of the markets just kind of coming down for a couple of days, it came down, and then it had this big, ugly red candle, which was kind of the deal breaker. And basically was putting that prior low right in focus and kind of confirmed that we were going to go down and through that. So I think it was Thursday maybe of last week that was really the problem. Let me highlight this economic report: inflation and jobs. Inflation and jobs. So the jobs number over the weekend, Friday, was too good. The markets didn't like that because a good jobs number, they said, well, that means the Fed's going to stay hawkish, continue to worry about inflation. Here's an inflation number, and these have drawn volatility. Now, it's my expectation that this will continue to slow. I mean, it's pretty well confirmed that inflation is topped. But how fast is it going to come down? And what does this show? If this is really kind of a disappointing number, meaning a very low number of inflation would be good for the markets, but might be bad for stocks, just in terms of, I guess you'd want to see inflation coming down, which would give the markets some sense that maybe the Fed won't continue to hike as aggressively. But you could look at it in the other way, as that they're saying, oh, we're doing something, it's working, and they might want to continue to push those inflation numbers down. It's a kind of a tricky market, but I would expect that you can kind of somewhat hang your hat on. If inflation comes down aggressively, you should see a market bounce, Could be a violent bounce for that matter, but we'll see. Earnings reports, you've got Citi, Delta Airlines, JP Morgan, Morgan Stanley, Pepsi, Taiwan Semi, United Health, Walgreens. I mean, a variety of different companies reporting this week. And this is really the start of earnings season. This is it. We're just kicking it off this week. Usually financials do that with Citi and JP Morgan. And then next week, more companies reporting. The next 2 to 3 weeks, we're right in the middle of earnings season and a lot of potential volatility that way. Have a great rest of your week. We will see you all next time. Goodbye, everyone.